This screencast is looking at the FurnCo question, focused particularly on preparing a flexible budget and then also interpreting that in terms of performance measurement. So again, I hope you've read through the question, and at least maybe attempted the first or second part of it. If not, make sure you do read through the question. So we're looking here at three separate requirements. One is to prepare a flex budget for 5,000 family seats. We then have to prepare a table that compares actual to flexed. So again, we would have done that in class with respect to the century question. And finally then is the more interpretive question in terms of what are the main areas of concern for further investigation and what other information might you want will be useful in that regard. So you can see to some extent here that on purpose I've given you a slightly different layout than the century question, where you're told here what the budget sales price is and you're told the budget was 6,000 units. Well, you weren't actually given the budget based on 6,000, you were given what's called a standard cost card. So that says for every seat they expect to have all these costs. And the one thing I'd say pay attention to is the fixed overheads in note 1 and how that works. And we'll come back to that again. So that we're actually not given the budget, the original budget at all, but we know what was made up of it. 6,000 units. And there's the standard cost card of all the variable costs and the fixed costs. And we're also told then for July they were under budget by 1,000 seats because they only manufactured and sold 5,000. And we're given the profit for July. So the first thing we're asked to do is prepare the flex budget for 5,000 family seats. So I think you don't need to do this, but what we'll also do as well is we'll prepare the original budget, which was for 6,000 seats. So it wasn't asked for, but it's useful for tutorial purpose to understand how that comes about. So if we'll do the budget, so I'll just copy down all these line items. And I'll say here, this is for 6,000, which we'll call the original budget. And then we'll do one for 5,000, which we'll call the flexed budget. Right, so again, you don't need to do the original, but it's useful to understand because this is a slightly different layout and purpose than the century question, just to see the students understand how to use the numbers. So if we take the original budget, you'd have 6,000 units times the revenue per unit, the budgeted sales price at 3,000. So that'll be 1.8 million. Right, so what I'll do this, I'll do it in thousands. I'll just copy these down, just so we have them all the same. Just copy the format. So I'm going to do 6,000, just 6 times 3,000. So again, I'm just leaving it in thousands, just to make sure you're clear. I'm just going to do euro, thousands. So we'll just make it easier if we can compare, because otherwise it gets very cumbersome in the cells. Then we have direct materials. Again, we're assuming here that direct materials, direct labour and variable overheads are usually variable. Now, unless told otherwise, whenever you see the direct ones, you can assume they're variable unless you're given a note to the question. So it's 6,000, drop the zeros, times 800. Again, minus 1 because it's the cost. The same with labour, 6,000 times minus 1,000, just to get it minuses. 6,000 units times minus 300. And 6,000 units times minus 100. Now, one thing to note here, pay attention to note 1, that they said the fixed overhead is shown in the standard cost card, calculated by taking the total budgeted fixed overheads divided by the budgeted number of units. So how that actually comes about is the total fixed overheads are expected to be 600,000. Now, that's important when we do the flex budget, not to think that that's a variable cost. A lot of the time, what companies do is they estimate the total budgeted overheads and they take the budgeted units to get a cost per unit. And that helps them then get a full cost for pricing purposes. But again, in reality, if activity moves, this cost is not expected to move. So the per unit one should go up and down, depending on what level of volume you have. So that's an important insight in terms of that is misleading on a per unit basis. And that's why you're given note 1 to make sure you use the information in the question. The fixed amount of overhead expected for the year was 600. And that's be careful when you're doing your flex budget. So the original budget expected a profit on 6,000 units of 4,800. However, we know that they only sold 5,000 during July, so we have to compare like for like. So we need to change the budget, or what we call to flex the budget, down to 5,000 units. And again, all we're doing is multiplying the 5 by each of these, but watch when we come to fixed overheads. So it's 5,000 units times 3,000. 5,000 units times 800 per unit for materials. 5 times 1,000 for labour, and 5 times 300 for variable overheads. Now the thing to watch here is it's not 5 times 100,000. Because remember, these are fixed overheads. You only calculated 100 at the start of the year, just based on your overall estimate. But actually these don't change. So it's still going to be the 600 from the original budget. And that's a little trick I brought in there to see the students understand what a fixed overhead is. Just because they're shown on a per unit basis, that can easily be done. But it doesn't mean that's what the behaviour of the cost is. Often companies want to have it on a per unit basis to inform them for price. But that, you have to always remember, is divided by a certain level of volume. And if that volume changes, that per unit would change as well. The other ones wouldn't, because they're variable costs, but this one would. So then your expected profit on the flex budget is 3,900. So we've fallen by 900,000 euro because you've 1,000 less of units to be sold. So that's your first insight in terms of preparing the flex budget. The key thing to note there was you didn't have to, but it's useful for tutorial purposes to prepare the original budget as well, just to see what their starting point was. And as well as that then, just to tally up this, you also would prepare the flex budget and look at the difference. So there's a difference there of a fall of 900,000, which we would typically call, based on the century question, the volume variance. That's how much profit you're worse off by because you sold less units. The next question then asks us, prepare a table. So remember the table we've done for century, comparing actual to flexed, identifying the key differences. Now, I think for complete purposes, we'll look at the three of them side by side. We'll look at the budget, the flexed, and the actual, just to see why or what type of insights we can get by comparing each of them. Right, so take your time, pause it now, and see can you try this before we go down. Because I'm just going to show you the table solution and we'll talk through it. So try and line up the first column, the original budget, the second column, the flex budget, and the third column, the actual budget, which is this one here. And see what can you compare. What is the overall difference? So how much profit are you down compared to the original, to the actual? And can you explain where that's coming from? Because that's where students are struggling. So if we go down and look at the comparison of each, so just open up this a bit bigger. So what we're looking at here is we have the original, which was 4,800. This is based on 6,000 units. The flex budget then is based on 5,000, and of course the actual is based on 5,000. So what we're looking at then is to compare. Typically what we do is we compare these two to get your volume variance. So the volume difference, the volume variance, is 900. So 900,000 is the difference because you've sold 1,000 units less than expected. And what we called in the performance variance is the difference between the two flex budgets. And you're saying that is a difference of 2,150. So the total variance is 3,050. And that, what we're looking at there is the difference between the 4,800, the original estimate, compared to the actual. And we're saying we split that up between 900 of that was due to a different volume. But more worryingly, 2,150 was due to poor performance. And if we compare these, we can see which line items were off. So here, for example, we were down 500 euro. Or 500,000 should I say, that we expected to sell at whatever number per unit, 3,000 per unit. We sold it a bit less because we only got 14,500 in. Materials was spot on, so we've no issue there. Worryingly, labour was 1,500, which as a percentage is very big of a variance. So it's clearly something going on with labour there that you need to investigate. Your variable overheads look fine as well. And your fixed overheads are 150 off. So again, your estimate of 600 at the start of the year, you expected that to be fixed during the year, but it ended up in 750. So something must have happened. We underestimated something, or a new fixed cost came in that we hadn't expected. But if we add them up, those key variances, that's our 2,150. That's solely down to comparing like for like, we still didn't hit the targets. So that's a performance variance. Whereas the other 900 was nothing to do for like, it was due to volume. That we lost volume, and we can quantify what that cost us in lost profit. So that's the key insight there. And remember, if we hid this, just for instance, if we hid this one, and we just compared original to actual, well, we'd have a huge drop here. But again, we're not comparing like for like, and that's where we come to volume in. But likewise here, direct materials, you think, God, you're very good, you're positive. But actually, that doesn't account for the fact that the 4,000 is actually making 1,000 units less. So there's a 4 million euro is for a different amount. Likewise, the labour for a different amount, and the variable overheads. So this comparison is not true. You need to isolate the volume issue and then compare on a like-for-like basis. Because it's comparing both of these where you'll be able to hold managers to account to say, well, if we originally budgeted for 5,000, you should have spent 5 million on labour. You ended up spending 6.5. So you're actually 1.5 million over. And that's a worrying issue. So that's what we're looking for in terms of students' ability here, is being able to do out the table, and more importantly then being able to isolate what things you're worried about. Yes, we're worried about volume, but more importantly, particularly in terms of the labour, that's one key issue. And as a percentage of the original labour, it's a significant amount. So you need to make sure you go back and investigate, well, what were the labour hours worked? So if we're looking at part C of this question, identify areas of concern, we've identified what other information. Well, you may want to figure out, well, how many labour hours were worked? So was that over or under, or was it to do with the rate? So was it the rate of labour that was paid? Maybe there was a new dispute, or maybe there was absenteeism, and we're causing this. Right. As well as that, you may also want to get a split of, well, why are we so off with our fixed overheads? So we're 25% above where we expected. How do we get that so wrong? Was there something, a poor estimate? Was there something new coming in? And we want to understand that. And finally, then we may want to understand details around the sales strategy. Because even when we dropped the price, similar to Sentry, we lost volume. So is that due to external market conditions, or are we poor in our sales strategy and our pricing strategy? So they're the kind of things I'm looking for students out of the part C to kind of give their managerial insight into what the numbers are saying. So really part A and B are really just technical. Here's the numbers, here's the variances. And then at the bottom, they're looking for what text or insight can you give. And just note there, F versus A, where we're talking about there is favourable or adverse. So when I talk about favourable, I mean a positive variance, so none of these are favourable, and we have 3 of these are adverse, or what we call unfavourable, meaning their negative variances were worse than expected. So that's what, if you ever see F versus A, that's favourable versus adverse. So a good variance versus a bad variance. So that question looked at FurnCo, which again is the follow-on from the Sentry question we would have done in class. Once you're comfortable with that, your next question should be LabCo. That's a more exam standard question. There's a lot more background involved. You can see there's a lot more detail in terms of the questions, and there is a screencast up there as well. So this was FurnCo based on flexible budgets and performance analysis.